We also welcome to the webinar Regan Van Rooy, a tax partner at Regan Van Rooy. Regan is a UK qualified chartered accountant with 20 years of international tax experience, starting at Arthur Andersen in London and thereafter at Deloitte in London. She then moved to South Africa, where she was the head of international tax at Sasol for 9 years until 2016. While in Johannesburg, she was also a part-time lecturer in international tax at the University of Johannesburg. Regan joined Regan Van Rooy in 2016 and now heads up the Mauritian office. And also joining us, the Director of Legal and Compliance for GMG, Kim Setskorn. Kim has been with GMG since 2008. She's based in the Mauritius office and presently holds the position of Director, Legal and Compliance at GMG Trust Limited. She's responsible for the overall compliance framework. And in 2003, and after deciding to leave legal practice, Kim joined Sentinel International Advisory Services to specialize in trusts and corporate affairs, as well as tax and structuring. So those are our panelists, and a warm welcome to all of them. And we thank them in advance for their time and their insights. And what I'm going to ask Haggai to do to kick us off is to just give us a very brief introduction to GMG Trust. Thank you, Haggai.
Can you hear me? Sorry.
Yes, we can hear you.
Yes, thanks, Matt. Thanks, everybody, for joining. So just in very brief, GMG is now getting close to celebrate its 20th anniversary. While we started here in Geneva in 2000 as a fiduciary service provider, over the years we developed many other businesses in the area of real estate, private insurance policies, wrappers, asset management, and some other initiatives. But what I want to focus in that introduction is really the fiduciary service, which is really at the heart of the discussion we will go into. That business today is really centered about a very strong execution structure in Mauritius. Many of our clients are very entrepreneurial and commercial active, so we are very used to execute for our clients, work with them very closely at any step of their operations, as operators in a fiduciary capacity, but very involved. I think that's really what separates us from many other similar fiduciary service providers.
Thank you, Haggai. So yeah, we're going to come back to you a little later on for your view from Europe. I'm going to bring in Regan now just to give us a little bit of background and introduction to Regan Van Rooy.
Thanks, Matt. Yes, we are a specialist international tax and structuring firm, and we focus on Africa, which means we help corporates and also high net worth individuals decide how best to structure their operations to minimize risk and to optimize their tax. Because we focus on Africa, Mauritius has always been a very key jurisdiction to us, despite the recent changes, which some people believe means that Mauritius is less important. Our main offices are in South Africa. We have offices in Joburg and in Cape Town. We also have a rep office in Ireland, and we opened our Mauritian office 2 years ago. And with the Mauritian office, we've been more focusing on the Pan-African advice.
Thanks, Regan, and we look forward to your insights in a short while. Marco, I'm going to bring you in here now. The relationship between GMG and Skybound Capital, which led to this forum being established today. Sorry, the saying of 2020, you're on mute.
Can you hear me now?
Yes.
Good morning, Matt, and good morning, everyone. Yes, Matt, it's very exciting to share what we have already shared with our clients and the Skybound team as well some few months ago, which is effectively the acquisition of the GMG Trust business by the Skybound Group. This is part of an evolution of the GMG Group, which over the years started with the trust and fiduciary services, but over the years decided to realign itself to other interests in other jurisdictions. And our relationship with Skybound started in 2016 with a separate commercial transaction. We developed an affinity and respect between our partners that way. And when we started looking at disposing and divesting ourselves, and now I talk as one of the two GMG partners on the call, which are Hagai and myself, when we started looking at divesting ourselves of the business, it was very clear that Skybound and Clifford Warren and his team were the appropriate partner for us to continue the tradition of service of our clients and not upset what we wanted to do. We have concluded that transaction apart from the regulatory approval, which always takes a little time, but we're almost there. And following that, we will be rebranding the business, but we are already operating as part of the Skybound stable. There'll be no significant change in the type of service that we provide, with the exception that we will be extending our services with the Skybound group and adding those services from Skybound to our clients. So a very exciting moment. Thank you.
Thank you, Marco. And before we get into specifics now on the topics, perhaps you could just contextualize for us the subject of Mauritius. It's been in the news a bit lately, but also if you can contextualize the change from an offshore to an onshore jurisdiction before we get into some of the specifics.
Yes, thank you. I think it is very important to take a step back and look at the changes that over time has brought to where we are today, not only in Mauritius, but with a global set of businesses which are operating cross borders and transient individuals. It started with money laundering, terrorism. It evolved in scandals like the Panama Papers. It increased the G20 monitoring, OECD monitoring, setting up bodies that put pressures and set up regulations across the world. And that was a significant moment for every so-called offshore jurisdiction. Some have done very little to react to these. Some have put in place processes that tick the boxes to appease the regulators. Mauritius took a different view. They took a view to become a fully onshore jurisdiction with a nominal tax rate of 15%, and therefore moving away completely from a zero tax regime of what was called the GBC2 type of companies. And all of that with proper substance in place. This process is not new. It started some 2-3 years ago in terms of from the legislation perspective, and in implementation it will end in June 21. This is a good thing. This is a good thing to make Mauritius a respectable jurisdiction on par with other European jurisdictions. And it comes with a plethora of DTAs, double taxation agreements, tax credits, rebates, tax holidays, which are perfectly allowed under first world jurisdictions. And Killen will talk a lot more about that. What is unfortunate is in this journey of respectability that was started quite some time ago, there's been something called the blacklisting that occurred, and that's I guess our next topic. And that blacklisting started in February 2020, but that's really providing the context, if you want, on this journey that Mauritius is going. And I guess the debate today is to make sure that we don't lose sight of this journey of respectability.
Yeah, so to some extent it has halted progress in that regard, but it is not the end of the road. And in fact, there's a lot of positive that we need to take out of this journey, and that is really one of the main things we're trying to highlight on this webinar. So let's get into our key themes. And before I do that, I'd just like to encourage people as we go along, as our speakers are doing their presentations, answering their questions, please feel free to put some questions into the Q&A function on Zoom, and we will get to as many as we can. We do have limited time, but the key thing is we will be able to see those questions after the webinar as well, and revert to any people who pose questions on a personal basis. So please do feel free to, as the webinar unfolds, to ask your questions. Marco, staying with you. So you raised the blacklisting and the topic of substance. So let's start with who has blacklisted Mauritius and for what reasons.
So there is a body called the Foreign Action Task Force, the FATF. That body has been mandated by the G20s to monitor countries' progress in implementing recommendations of which are anti-money laundering and terrorism. That body, the FATF, put Mauritius on what they call a grey list, so a list of countries that requires high monitoring in February this year. So this was something which was expected. It was not unusual, and something to be pointed out is that the FATF has got some 40 regulations that need to be abided to, and Mauritius had failed to demonstrate they abided 5 of the 40. So 35 of the remaining of the regulations were all the FATF is comfortable, but 5, and these specific 5s were demonstrating that the supervisors of the financial services businesses implemented risk-based supervision. It was ensuring access of beneficial ownership by the regulators. It was failure to demonstrate that law enforcement has the capacity to conduct complex money laundering investigation. It was a failure to implement risk-based approach in non-profit organizations, and adequate implementation of targeted financial sanctions. Now, this was identified by the FATF, and as a reaction to the FATF, the European community decided, as a surprise to everybody, to put Mauritius in a category called blacklisting. Now, the technicalities about it is that there is no real change in the grey listing of the FATF, except that they required the country to implement these last 5 regulations. But the implication of an EU blacklisting, which is totally linked to the FATF grey listing, is that the transactions that occur with EU jurisdictions require what it's called enhanced due diligence. So this is more information when you're sending a bank transfer from from Mauritius to a European jurisdiction. This is what it means. And then, so the journey that that the country is now enterprising is to get out completely of the FATF monitoring system, and then once they've done that, automatically within a period of 4 or 5 weeks, the EU would delist from the blacklisting Mauritius.
I'm going to bring Kim in here, Marco, if I may. And Kim, good morning. We haven't heard from you as yet, but can you give us some context around how many other countries were blacklisted, and who are they? Thanks, Kim.
Sure, Matt, and good morning to the audience. So currently on the list, there are 22 countries. 12 of those countries were only introduced as of 1 October 2020. So just to contextualize that, is the EU updated the list in May of 2020. However, due to the pandemic, the effective date was delayed until the 1st of October 2020. What I'll do quickly for you is just share my screen, which will then give you an idea of the list of countries that appear on the list. Can you see the screen?
Yep.
Perfect. I'm just going to enlarge it. All right, so the entities marked, or the countries marked with an asterisk, are the countries that were added recently in October 2020. And interesting to note is that in yellow, the Democratic People's Republic of Korea and Iran are actually countries that are listed on the Foreign Action Task Force blacklist, which means that countries are internationally are restricted from dealing with those countries. So what we're showing here is a little bit of a mismatch, because we have countries that sit on the FATF grey list, which are only subject to enhanced monitoring from the regulators, versus the EU blacklist, which includes countries that are completely restricted. So, and countries that are sitting on the list are at varying degrees in terms of compliance with the 40 recommendations. So you have countries, for example, like Barbados, that have 8 of the recommendations that they have not complied with. And you have Mauritius, for example, that has 5. But within those regulations, what is important to note is that Mauritius has met what they call the Big 6, whereas other countries have not met the Big 6, and the Big 6 are the ones that you are able to identify your beneficial owners. You are able to conduct the enhanced due diligence, and you have criminalized the money laundering and terrorist financing.
So there's positives there, Mark. What does the blacklisting mean for our Mauritian structures, and how long will Mauritius be blacklisted?
In short, I mentioned that what happens is if you're doing a transaction, an investment, or sending money over in a European jurisdiction, you will have enhanced due diligence. This is not new. The banks, like Investec, have been doing enhanced due diligence with the corresponding bank. So we have not seen real evidence of any of these European transactions being stopped or alternatively unduly delayed. But it is a risk. It is a risk that on the receiving side, there is a bank or a company that will not necessarily apply the enhanced due diligence, but make it a policy not to receive funds or to Mauritian company. So it is a risk, but we have not seen widespread this or specific cases within our company. In terms of the timing, these 5 recommendations have already been implemented. We have seen the government going to access a set of audits and applying regulations and penalties. So the matter has gone through the plenary sessions in September and to the FATF plenary sessions. And what the plenary session the FATF needs to do is send assessors physically in the country, and that will probably be around about February or in the course of the first quarter of next year. So our view is that between February and July next year, Mauritius should be able to demonstrate that they are compliant against these regulations, and by then being able to get out of the FATF lists as well as the EU blacklisting. So this is our current view.
So Kim, in the interim then, what would the impact be on assets held within a Mauritian trust and company structure, if any, while we wait for this period of time?
So just to emphasize what Marco has said is that there's no restriction on EU member states dealing with Mauritius structures or Mauritius individuals. The only side is that there would be an enhanced due diligence that would be carried out by those EU financial institutions when doing business with Mauritius entities. So the quick answer is there's no legal impact from an ownership structure on any of the assets that are held in Mauritius structures.
And would there be any impact in the interim, again, on transfers or distributions that clients need to make to beneficiaries?
So just once again, just following on from what Marco said, ideally there should be no problem, as most of the Mauritius banks had connected with the correspondent banks and with recipient banks to understand what this enhanced due diligence needs to look like. And if we manage it correctly on the upside when we're starting a transaction and going through the transaction and manage it from an enhanced due diligence perspective, there should be no delays.
Yeah, I mean, these are questions that are being asked, and understandably being asked. Will money sent from Mauritian trusts and companies be returned by foreign banks? Practical question.
So again, there were no reason to return the funds if on a normal banking platform we have adhered to and complied with the correspondent and ultimate bank's enhanced due diligence requirements. No restriction to deal with the banks or with Mauritius.
And finally, Kim, is there any chance of sanctions of any kind being placed on Mauritius?
Not at this stage at all.
Okay, so some very reassuring news then. I think it's important that we get the message across that blacklist does sound like a very tough situation. It sounds like it's something that's going to prevent companies, trusts, and so on transacting, but that is not the case. And Marco, to your point, a lot of what is required has been done for some time in any event.
This is a very good thing for Mauritius at the end. It will have a bit of pain now, but at the end it will come up with a very stronger set of systems.
Great. Well, thank you, Marco and Kim. Marco, we're going to come back to you a little later on. I'm going to move on to Keelan now, our tax expert. And Keelan, perhaps I could start by asking you, why is structure important from a tax perspective?
Thanks, Matt. And I'm just going to share my screen to go through the slides where we talk about that. And what we want to focus on today is really to make it clear that the recent and very significant tax changes in Mauritius are not bad news. What Marco has said is that Mauritius has taken pains to basically become known as a good boy jurisdiction rather than a bad boy jurisdiction, which, although it means a headline 15% tax rate in some instances, because of the tax benefits that have been brought in hand to hand and the some of the enhanced substance requirements, for instance, overall makes Mauritius a more amenable jurisdiction in many ways. So what we're going to look at today is basically, why is Mauritius relevant from a structuring perspective? And the first question is, why is structure important? So the main reason why we look at how to structure any transaction or any group is from a risk perspective. So if you have the right structure, it's a way to limit your shareholder risks and your shareholder liabilities. It's also a way to reduce any specific country risk or currency risk. It's also very important in protecting your intellectual property. It can be used as a way to get better access to funds, or to make it easier for investors to invest in your entity. And obviously tax, always a big factor, to optimize your overall tax position and to be able to exit from your entity, in terms of which tax is also particularly relevant.
And I know you believe, for one, that it's especially important for African operations.
Yes, that's right. And as I said at the beginning, our focus at Regan Van Rooy is on Africa and on how to structure for Africa. And Africa has very particular risk areas for which structure is very important. And I, for one, am of the view that the OECD and the EU Commission, who put Mauritius on these various blacklists, particularly in terms of the tax grey list, don't understand why corporate structure. And particularly in the African context, they don't understand the risks that we're trying to work around. And tax is by no means the biggest one. So in Africa, when we have a group working around Africa, a big risk is always multiple currencies, which typically are very volatile. Linked to that, most African countries have very restrictive exchange controls, which make it hard to move your money. And even worse than that, we often have shortages in foreign currencies. So if you're doing business in Africa, you can have a situation where you're earning money in country, you have gone through the process of getting permission from the exchange control body to take it out, but there is simply not enough foreign currency in country to make your payment. So that is a fundamental economic and business risk for countries or for companies, and one where Mauritius, for instance, can be used to alleviate the problems. On the tax perspective, as anyone working in Africa knows, withholding taxes are a killer, very high withholding tax rates, and generally they apply on everything that moves. And the taxation authorities are also very aggressive, particularly in terms of foreign held companies. And just to make matters worse, there's also, in many African countries, it's hard to get a clear answer on what the law is or what the precedent is, and often they can be very different. And many of the countries either do not have double taxation agreements, which can give certainty to the corporate in terms of its cross-border transactions, or else the DTAs are not very favorable. So these are specific risks which are particularly live in the African context. And for all of these, they can generally be mitigated by holding through a kind of safe jurisdiction with no exchange control, with tax benefits. And Mauritius to date has been the kind of go-to gateway to Africa. And we believe that it remains the best option for structuring into Africa.
So Keelan, just expand on that, because it's clear that you still professionally believe that Mauritius is a relevant jurisdiction. It makes sense, as your slide says.
Yeah, and Matt, that's why we're very happy to have the opportunity to discuss today, because we've been quite concerned of the misinformation that's out there. A lot of people are either not aware of the changes in Mauritius and therefore are not getting ready to deal with them, or worse, have just heard on the grapevine, and often it's a message perpetuated by other jurisdictions, for instance, such as Jersey, that Mauritius no longer works. Mauritius is now a high tax jurisdiction. Mauritius is trouble. And we very much feel that that is not the case. So does Mauritius still make sense is our question. Our answer, in terms of spoiler alert, is yes. It actually makes more sense than before, and we're going to go through that over the next few slides. But the real benefits of Mauritius, and particularly in the African context, are no exchange control, and you can work in whatever currency you want, and there's a very strong and developed banking infrastructure. Mauritius also has a very good network of double taxation agreements, which is critical when you're doing anything cross-border, particularly in an African context, because of the problems we spoke about on the last slide: aggressive tax authorities, high withholding taxes, all of that. So Mauritius has 46 double taxation agreements in force, 4 about to be ratified, and 15 under negotiation. So that's a very good number, second only to South Africa in terms of the African continent. We're now off the EU and the OECD tax grey lists. And the reason we're off those is Mauritius has brought in the changes that the EU and the OECD insisted upon. Unfortunately, we got off the tax grey list the end of last year, just in time to go on the foreign currency blacklist, which is very unfortunate. But as Marco and Kim explained, in practice, that will not impact businesses. But from the tax perspective, Mauritius has done a very good job in ensuring that it remains seen as, that it is seen as a friendly and cooperative tax jurisdiction. And it has gone to great efforts to get off to stay on the right side of the EU and the OECD. Another big benefit for Mauritius is it's either got no withholding taxes or very low withholding taxes. And typically that is a significant additional cost when you're flowing through an intermediary holding jurisdiction. So Mauritius, still great, but then these are the things that people have heard about, So as in 2018, and because the EU and the OECD were putting Mauritius under a lot of pressure due to what they saw as Mauritius's favorable or unfair tax regimes, Mauritius decided, as Marco explained, to basically be seen as a good boy. So we got rid of the deemed tax credit, which was the regime that's been the backbone of Mauritius's attractiveness as a holding company. And that basically meant that 80% of your tax bill was deemed to relate to foreign tax credits, and you got an automatic rebate for it, which gave you an effective 3% rate. And also the GBC2 regime has now been gone. Both of these are grandfathered until June next year and then will no longer be possible. Also, Mauritius was kind of forced to bring in substance rules and control foreign company rules. And these were specifically as indicated by the EU and the OECD. Now, the substance rules, I think most of our audience is probably in South Africa, and if that's the case, the Mauritian substance rules will never really be an issue, because the larger problem is always the South African substance rules in terms of either tax residence or control foreign company or transfer pricing. So the substance rules, they have gotten stricter here, and they do have requirements in terms of particularly your expenditure and number of employees. But in general, particularly for businesses who have a South African parent or ultimate beneficial owner at the top, it won't be any additional risk. Mauritius was also forced to bring in control foreign company rules by the EU and the OECD, which makes absolutely zero sense. But to keep the EU and the OECD happy, they were brought in, and the rules will almost never impact. They basically apply if a Mauritian company has entities below it in a low tax jurisdiction. And then, of course, the other bad news is the blacklist that Marco has discussed. So in summary, Mauritius still makes a lot of sense, but there's a lot of negative press around the changes on the blacklisting, as we've discussed, and more particularly on the tax changes. And what I want to look at in the next few slides is explaining that even though the deemed tax credit and the GBC2 no longer exist, Mauritius is still favorable from the tax perspective, because there's a lot of very generous regimes that can be availed of. So basically, we're in the new Mauritian tax regime from June next year, where there's no deemed tax credit, no GBC2. So in theory, a 15% rate applies, which is good news in terms of the OECD and the EU. And as Marco has said, it kind of paints a good picture of Mauritius. It's not a 0% tax regime. However, there are three main fields of exemption, which in many cases can bring you down to essentially a 3% or lower tax rate. So I just want to say that again, because I think that's very important for our listeners today. If you are conducting a business, particularly in Africa, and you are conducting meaningful operations, there is no reason why you should not be able to avail of a 3% or lower tax rate in Mauritius going forward. And we go through the three ways here that could be possible. The first one, which is for us the least exciting, is what's called the partial exemption regime. And this applies, it basically gives you a 3% effective rate, so very similar to the deemed credit, but getting to it by a different way. And on certain income streams, the 80% of the income is deemed to be exempt, so you only pay an effective 3%. And that's foreign source dividends, interest income, profits of a PE, and certain very specific income related to financial services, particularly CIS funds and reinsurance, and other very specific activities, basically fiber and aircraft leasing. So if you're earning any of these income streams, all you're going to pay is 3%. The next one then, which is actually extremely generous in Mauritius, is there are 19 new tax holidays. Now, all of these apply either for 5 years or for 8 years, and it's a complete holiday on any corporate tax. Now, Maggie Thatcher was the one who said a week is a long time in politics, and 5 years or 8 years is a hell of a long time in tax. So getting any of these holidays and knowing you're paying 0% for either 5 years or 8 years is a great situation to be in. Also because you get clarity up front whether the tax holiday will apply. Now, I'm not going to go through these in detail. Many of them are very specific. So for instance, using ocean water to make air conditioning. You know, you're not going to decide to move into that branch of business just to avail of a tax holiday. So some of them are very, very specific, mainly the ones on the right-hand side of the screen, but some of them are very general and can apply in many situations, particularly where there is a large group that is conducting activities in many jurisdictions. So the one that we're very interested in is the Global Headquarter Administration Tax Holiday. And that basically applies if you have a Mauritian company that provides various support or strategic services to at least 3 entities within the group. So if you've got a group of companies and there's at least 4 of them, and you've got people in the Mauritian office who are providing some sort of back office or support or invoicing or strategic input, it is very well worth looking at whether this tax holiday could apply to you. And it applies for 8 years. And particularly in the African context, where, as we know, there's big issues with foreign currency and withholding tax on payments out of Africa, this tax holiday can be used to actually expand the activities that are taking place in Mauritius to ensure that payments come into Mauritius rather than into the African country and then out to Mauritius. So it's a way that can optimize not only your group tax situation, but actually your overall group risk situation and your exchange control issues and your currency issues. So there's a lot of scope here, particularly for businesses who have operations around Africa. Similarly, there are also broad tax holidays to do with if you're providing global treasury or legal advisory services, which are actually quite broad, or if you're running a family office. Then there is also an innovation-driven tax holiday, which is basically for IP or research and development, and that is also for 8 years. It's quite specific, as all R&D tax holidays globally tend to be, but it can apply where the group has significant IP, so it's well worth considering. Then if the tax holiday doesn't make you happy enough, or if you don't fit within one of the exemptions or find that it would be worth your while shoehorning what you're doing to get into one of the holidays, Mauritius also has an extremely generous foreign tax credit regime. Now, the regime was basically copy and pasted from the UK double taxation relief system, and it is much more generous than, for instance, the South African regime. If anyone has spent their time looking at 6 Quat, they would be very excited to see what you can claim in terms of Mauritius. As you know, generally a foreign tax credit is a deduction against your Mauritian tax in respect of foreign income you've earned where you've suffered foreign tax on that. And again, if we're looking in the African continent, apart from Mauritius and to some extent Botswana, every country in Africa is a high tax country, and every country in Africa charges high withholding tax. So in general, where you have payments flowing from African countries into Mauritius, in general, you're always going to be able to offset your withholding tax against your headline 15%. So let's say it's easy to kind of get a broad view of whether this would help you or not. If you know you're getting payments from your subsidiaries and the average withholding tax rate is 15%, which is very common if, for instance, you're providing services, because services typically have the highest withholding tax, then you know you're not going to be paying any tax in Mauritius. If you know your average withholding tax rate is 10%, then you know you're going to be paying 5%. So it's fairly easy to know whether this is going to be beneficial. And 9 times out of 10, if you are a business that is operating around Africa, the foreign tax credit regime will get you home so that you pay no tax, or certainly less than 3% tax in Mauritius. The other benefit is if the Mauritian company receives foreign dividends, they can claim foreign tax relief in respect of the withholding tax on the dividend, but also in respect of the underlying corporate tax on the profits out of which the dividend was paid. Now, in Africa, where the general corporate tax rate is 30%, this gives you a hell of a lot of tax credits that then can be offset against other income. So in our view, the partial exemption regime, although a lot of people think that that's replacing the deemed credit, in our view, it's too restrictive and not helpful enough. In our view, the foreign tax credit regime will 9 times out of 10 get you to a situation where you do not pay more than 3% tax in Mauritius. And so you can pool your foreign tax credits if you have excess credits on one income stream, you can set them off against the tax liability on the other income stream. The one bad news is that you cannot carry forward excess credits. But otherwise, the foreign tax regime in Mauritius is extremely generous. And the question here is, first of all, what withholding tax are you suffering? And if it's close to 15%, then you don't need to worry. You're not going to pay tax in Mauritius. But if you do have a low withholding tax, then it's worth looking at, are you receiving dividends somewhere in the group from a high tax country? And if you are, the question is there an opportunity to move those dividend receipts to Mauritius so that we can claim the foreign tax relief in respect of the underlying dividend? And that is it.
Well, Keelan, I'm sure it's not quite it because it's such a detailed and wide-ranging topic, and that's reflected in some of the questions that have been asked by clients. However, I am mindful of time, and as I said at the start, we are going to make sure that our panelists receive the questions and that they are answered. But I think with that tax information in mind, I'd like to go back to Kim. And just for a quick refresher course, Kim, on Mauritius structures, what is available in Mauritius as a jurisdiction?
Thanks, Matt. I'm going to share my screen with you. Can you see the screen?
Yes.
Perfect. Perfect. So what we've done here is we have just highlighted that Mauritius offers all the structures that are typically used in your corporate and personal structuring. The structures are also supported by modern and robust legislation that is principally based on English law principles. What is also nice to note is that the Mauritius highest court of appeal is access to the judicial committee of the Privy Council. And obviously Mauritius has well-qualified and multilingual workforce to support all of the substance requirements and to support the structuring which is necessary to enhance the structures. So in the interest of time, Matt, we're going to just have really a look at the two most common, which would be your trust and your company. I'll start with the company because it ties in quite nicely with what Keelan was saying in terms of harmonizing of the tax regime and making sure that there was no discrimination between the tax rates. Three types of regime have come to the fore. The first is the authorized company. Now, the authorized company is a company that is incorporated in Mauritius. However, it is not tax resident in Mauritius, and its place of effective control and place of effective management and control must be outside of Mauritius, and it's required to file an annual return with the Mauritius Revenue Authority. The second is the domestic company. This is effectively a company that does principally work inside Mauritius and has more than 50% owned by Mauritian citizens. Where you have your work principally outside of Mauritius and you have more than 50% owned by non-citizens of Mauritius, then you will be required to apply for a global business license. And this is a license that is issued by the Financial Services Commission in Mauritius, and the company would be regulated by the FSC. Your domestic companies and your authorized companies would still be subject to AML, what we call your anti-money laundering and combating terrorist financing in Mauritius by the Registrar of Companies. So no distinction from a regulatory perspective other than the body that governs them. And as we've said, the tax rate there is the 15% harmonized, and Keelan has addressed the options that we have available there. Also typical is that you have public companies, private companies, and the most common and important to note is the limited liability company. We then also have the trusts. The trusts are based principally on the laws of England. It's common law based. And obviously your assets would vest in your trustees and under the control of your trustees. Mauritius allows for the appointment of protectors, which would then allow you to be able to guide the trustees in exercising their discretions. We do have information on the others, but in the interest of time, we will address those separately.
Thank you, Kim. And so I think now we hop from the warmth of Mauritius. We're going to head north and slightly west to where Hagai says it is still cold and dark in Switzerland. But Hagai, have you experienced issues at all with European banks or other financial institutions around the Mauritius blacklisting?
Yeah, thanks, Matt. First of all, it's getting a little bit more light here, but still cold. You know, it's the sun is behind the clouds. In terms of the, you know, I've been observing very carefully because I was very cautious that European counterparties, you know, business counterparties, commercial counterparties, banks or financial institutions will start to hit the brakes on transactions. I must say, we see hundreds and hundreds of transactions every month. I had only one query from a Spanish bank for a transfer to Mauritius. All we had to do is to say, here's the invoice, this is what the payment is for, and the next day the payment was released. So they may apply a little bit more what we call enhanced due diligence, but this is really, I've seen next to nothing of it in terms of slowing down any of our clients' business. What I must say that is the other side of the coin is that because Mauritius stepped up its regulations and the regulatory framework, and also putting the tax rate at the top rate at 15%, it is not considered as a low tax jurisdiction anymore. So if the other day I talked to a Dutch tax advisor, and we talked about a transaction with a Mauritian counterparty, and he said, well, that's not an issue because Mauritius is not a low tax jurisdiction, so we have no issue with the, we don't anticipate any queries. So that's really a very positive sign. And I just want to make one short comment. Everybody in any jurisdiction now around the world talk today about substance. Anything has to be supported by substance, by real people that do real work in a jurisdiction where you want to book your income. We have a great advantage in Mauritius. First of all, the workforce is very qualified, relatively cost effective, and we as GMG we have a very well-oiled machine to provide that substance to our clients, which we've been doing for years. But I think now they can really rely on it when they come to set up shop in Mauritius and benefit from all those great advantages that Keelan just mentioned.
So Hagai, notwithstanding what we've heard and read recently, would you say the general mood towards Mauritius remains positive in your opinion? And to what degree is it still associated with the offshore world?
So, you know, it's still regarded as a, you know, a holiday destination where the sun is shining and the coconuts are falling from the trees, and you have to watch for that. That's a risk. But I think, again, it will take time. I mean, it's, you know, image takes time to change. But I think with time, and again, with practically the legal framework, for example, that takes Mauritius out of the low tax jurisdiction list, that will filter its, you know, its way down to people's mind. And at the end of the day, banks and tax jurisdiction, they really work according to, you know, checklists. They don't necessarily work by image. So I think definitely we are in a very, we have a very positive way ahead of us if we really manage to clear some of these concerns around the blacklisting, which I think should happen early enough in 2021.
Thanks, Hagai. We have a couple of minutes remaining at our disposal. So before I ask for some closing comments, I'd just like to reassure participants who have submitted questions. We even got some prior to the webinar. But I'm sure you'll agree that the extent of the information that's been shared in the last 55 minutes has been impressive, and it's been comprehensive. And we really do look forward to sharing your questions that we haven't had time to get to with the rest of the team, and they will be answered for you. So please do bear that in mind. Marco, I'm going to perhaps return to you and Hagai for some closing comments about Mauritius as a relevant jurisdiction for your structures. I mean, Hagai references the beach holidays and the coconuts. You're clearly not into any of that. There you are in Mauritius in your suit. It has been something you've been passionate about for a very long time. And my takeout from this is that you remain so, and that actually the future looks even brighter, in your opinion.
Thank you, Matt. We operate and provide services across a number of jurisdictions. We have Switzerland, we provide services from UK, Luxembourg, Mauritius, BVI, Dubai. Each of these jurisdictions we use as putting a puzzle together of structuring for our clients. We find that the changes, the recent changes that are being discussed in Mauritius are creating Mauritius as a better hub for us in terms of providing these services and having one or two Mauritius structures as part of an overall structuring that we do with clients. So that combined with what Hagai mentioned as a low-cost, high level of education, available workforce. If you go into an island of 34,000 people called the BVIs and versus an island of 1.2 million people, you have a different number of workforce and education available. And that also applies to Guernsey, by the way. and so we see Mauritius not as the only jurisdiction, but definitely as a value-added jurisdiction in our set of solutions that we provide our clients.
Hagai, perhaps a closing comment from you? Sorry, you could unmute.
Sorry.
Thank you.
Yeah, I agree with Mark, and just saying again, you know, like Marco said, it's one of the services we provide. And I think what we built in Mauritius over 20 years in terms of the qualification, the management structure, the systems, the discipline, the procedures, I'm proud to say that I think it's second to none, and it's proving itself every day. Really, we work with very intensive, commercially intensive clients that trade globally, from anything starting from, you know, mining to real estate holding or development, bitcoins, high tech, food additives, you name it. And that structure is robust, and it's proving itself day in, day out. So I'm very, and with the those changes that Keelan just mentioned, I think we really perfectly structured and based to provide that service going forward. I'm very optimistic about that jurisdiction going forward.
Well, thank you both, and also a huge thank you to Keelan from Regan Van Rooy, and to Kim, who's joined us today. I think all our panelists would agree, or our participants would agree, that the extent of the experience available in this team, the years under the belt, and the experience across multiple jurisdictions is a great source of comfort. And we really do look forward, as I said, to addressing your queries and your questions, but also to building long-term relationships within this partnership. So Keelan, Kim, Hagai, Marco, thank you very, very much for your time today. And may this be the start of long-term future engagements. Thank you all for your attendance, and have a wonderful weekend.
Thank you, everybody.
Thank you.